Let's start the next session, story of University of California investments, mastering long-term success through strategic asset allocation, active management, and strong organization culture. Before we introduce the speaker, let me introduce the moderator, Rajesh Sehgal, who is the chairperson of CFA Society India and managing partner at Equanimity Investments. Rajesh has been a long-term investor with tremendous breadth and depth of experience managing early-stage investments, private equity, public equity markets for over 2 decades. He had a long stint with Franklin Templeton, where he worked for 17 years with Dr. Mark Mobius. He's an alumnus of Wharton School of Business, XLR Management Institute, and is a CFA Charter holder. Rajesh, please take over.
Thank you so much. So very good morning to everybody. I think we've had a great session so far, and I promise you the next hour and a half, we have a gentleman here who's really going to be adding a lot of value to all of us individually here. It's my pleasure to introduce the next speaker who's going to talk about global investments and how he sees investing in wealth management, asset allocation, etc., a host of topics. So please welcome Satish Swami, who actually flew here from California the day before to join us in person. He is a senior managing director for University of California on the investment side in their investment office. He's been there for over 26 years, has had a stellar career. He's involved in managing over $180 billion in assets. He's, I think more importantly, and that's the other side of him, is he's an educator. So he teaches, he's a professor with Haas Business School at Berkeley. I think I was given a very long introduction, and then he was very insistent that please don't read all of this. Just tell them 2-3 things. They should know me. I will tell them what my background, my story, etc. So let me not stand between you and him. Satish, the floor is all yours. A big hand for him, gentlemen.
Thank you for the introduction. But more importantly, I want to thank the CFA Society of India for having me. It is an honor to come to India, which is probably the most dynamic capital market today. And it is very important for global investors to understand India and what the roadmap looks like. And I'm going to be talking about a couple of things. First, I'm going to mention to you that of all the academic credentials I have earned, probably the CFA Charter has been the most valuable to me. So the CFA Charter grounded me in investment principles. It does a deep dive on global capital markets. It talks to you about the different asset classes under the sun across the world. So you will not find a better underpinning if you want to learn, if you want to be a student of the capital markets. So I owe it to the CFA Charter, to the CFA Society. And part of the giving back to the CFA community was I have been very actively involved with the San Francisco Society. I was on the board from 2004 to 2012. And in 2010, I was the first foreign-born president of the CFA Society of San Francisco. And I continue to be engaged. Thank you. So the other thing about the CFA Charter is, and the CFA Institute, is the power of volunteering. Even after I earned my charter, I spent hours because I was hungry to talk to people. I was eager to meet other investment professionals. I learned a lot with networking, and even today, I really made some great content. And it's been a fantastic experience. So that's on the CFA side. Before I launch in and talk about the story of UC Investments, I want to tell you my own personal story. I actually grew up a few kilometers from here. I grew up in Sion. I went to the Little Angels High School, and then I went to the SIES College, all in Sion. And there were two things I did very well when I was growing up. I played a lot of cricket. So if you understand, if you know Sion, when I was growing up, there used to be this huge playground right behind the bus depot. I don't know if it's still there. I probably spent, out of the 18 years, I probably spent half my time, on the playground playing cricket. The other thing I did very well, I watched a lot of Hindi movies. I was fascinated with Rajesh Khanna and Amitabh Bachchan. And I remember going to Minerva Theatre when Sholay, I know, I'm dating myself, and I see a lot of the younger generation. I used to take the bus and go to Minerva to see Sholay because it was 70 mm. I was fascinated. I was fascinated with Hindi movies, and I was playing a lot of cricket. So my parents decided that that I needed a change of landscape. So they felt that I was not going to go too far with my cricket skills, because I was not going to replace Sunil Gavaskar and Gundappa Vishwanath, nor was I going to become a Bollywood star and replace Amitabh or become a huge Hindi movie actor or anything. So they said, you know what, we have a different plan for you. So they actually moved me to Bangalore. So after my high school, at the age of 18, after my 12th standard, I moved to Bangalore, and I did electronics engineering. And as soon as I completed my bachelor's in engineering, I moved to the States. I wanted to study more. So I was talking to Andrew Caruso, who's here from the Consul General's office, and I met him and the Consul General a couple of days ago. To get the student visa 40 years ago, in 1984, I went to the US consulate in Breach Candy. It was a fascinating experience. I took my student visa, I went to the US, got my master's in engineering, and I started working. When I started working, and this was like mid-80s, technology was going through some revolution, technological revolution. We had cathode ray tubes, then we had transistors, then we suddenly had the microprocessors, then we had supercomputing. I was working for 2-3 years, and my head was already spinning. I said, wait a minute, technology is changing every day, and this is really not sustainable for me. I didn't sign up for this. I didn't want to be a part of that because it was too much. I wanted to do something easy. So by chance, I happened to get into the University of Southern California to get my MBA. And I started taking investment classes, and my engineering background enabled me to understand the mathematics behind investments very easily. CFA charters, and people are aspiring to be CFA charters, there are only few formulas. Investments is done by a handful of formulas. It's all 17th century mathematics. I said, this is what I want to do. This is easy. It is not changing. It's the same formulas. It's being spun around, and dividend discount model, and fast growth model, and duration and convexity. I said, I can handle that. No problem. So I started working with my MBA. I started working on the CFA Charter because I wanted to learn more. And then in 1998, I joined the University of California, and I have been there for 26 plus years. And that is the story. What happened at the UC over the last almost 30 years. I'm going to take you through a journey of 30 years at the UC. I'm going to show you how assets have grown. And more importantly, I'm going to share with you the trajectory of asset growth. Because remember, from 1990 onwards, till the pandemic, there were major market moving events pretty much every few years. Russian crisis, the Asian crisis, the dot-com, then you had the great financial crisis, then you had the H1N1 flu, then of course you had the pandemic. So I have navigated through many market cycles. So what I want to share with you today is some of the principles that has helped me to be where I am today, and that's the story I'm going to tell you. There you go. Okay. So the story of UC Investment. So I work for the University of California. It is amazing. I came here at 11:10. I met 4 people from the institute and from the industry here outside, and everybody had either their better half or their kid in the UC system. So that is the power of the University of California, with 300,000 students across 10 campuses, 5 world-class medical centers, where we serve 300,000 employees in the UC system. So it's a pretty powerful ecosystem in the state of California. And today, the University of California is the #1 public research university in the world. And that did not happen by chance. The mission of the UC is research. And so it is not a shocker that today the UC has produced more number of Nobel Prize than anybody in the public university system. Of course, there's a few private colleges that have more, but in the public space, UC has the maximum number of Nobel Prize winners. Okay? So I'm going to talk about portfolio background. I'm going to give you a snapshot of what the portfolio evolution has been, and more importantly, what the portfolio looks like today. And then I'm going to walk you through the different stakeholders that I manage money for. I'm going to talk to you about the importance of asset allocation and investment policy statements. That is really the guiding light for investors. After I do the portfolio background of the University of California, I'm going to talk to you about a few case studies that I have actually constructed, and I use these case studies when I teach at Berkeley. I teach an elective in investments for second-year MBA students, and it's a real-world application where I'm talking about not any cases that happened, but I'm going to talk about real-life cases that I have witnessed, and what did I do, how did I manage my portfolio in an environment like that. Okay? It is important to talk about your track record, but it is also important to talk about what are some of the lessons learned. So instead of saying, what were some of the mistakes? Actually, a positive spin on this is, what were some of the lessons learned, and how do you avoid some of the mistakes in the future when you see a similar scenario? I'm going to talk a little bit about future outlook, how we see the world, what does the global investment landscape look like, and more importantly, where is the money to be made, and what are some of the most interesting areas of investment where large institutional investors need to put money to work. Nothing happens without risk management. Even before I'm a portfolio manager, I'm a risk manager. Risk rules. It is not about return on capital, it is the return of capital. Can you get your money back? Do you have liquidity? Can you get liquidity? Because you need daily liquidity in a UC system. We need to pay bills, we need to pay our employees, we need to fund research, though that's not going to stop. So I'm going to talk about what are some of the risks, what keeps me up at night, what am I worried about, and how do I intend navigating some of these road bumps. And finally, I'm going to tie all that I spoke about and drop a few nuggets here and there about some key terms and summarize the whole thing for you in what we call as the University of California Investments Way, which is really 10 pillars that define the organizational culture of the UC system. Having a strong culture and following the culture, very important. When you hire new employees, you want people to sign up for your culture. You don't want somebody to come in and then, it's okay to have a difference of opinion, but you don't want somebody upsetting the apple cart and changing the culture of the organization. What we are today is the UC Investments Way, and that really defines the way we manage money. I want to take you back to 1995. 1995, our assets under management was $23 billion. Yesterday, August 1st, we announced our fiscal year results for July 1, 23 to June 30, 2024. The assets have gone up from $177 billion to $180 billion. So as of today, we are at $180 billion. But keep an eye on the chart, because the chart tells you something about asset growth. For almost 20 years, it was kind of, moderate growth. But something happened 10 years ago. From 2014 onwards, the market just took off. What happened? And how did we monetize that? What did we do to kind of capture that growth? Did we leave money on the table? Or were you able to participate in the market and increase your AUM? Asset allocation. I said I manage $180 billion. $180 billion is divided between public and private markets. In the public markets, I have global stocks, I have global bonds. In the private markets, I have private equity, real estate, some hedge funds, and some private credit, and some real assets. So we are pretty much invested in everything under the sun. Because it's a $180 billion pool, you want to diversify your assets, you want to have many uncorrelated assets so that some assets do well when other markets are not doing well. That's the power of diversification. And the lesson to you, and it gives me goosebumps standing here, because I grew up a few kilometers from here, and I'm talking to probably the most energetic. Every time I come to India, I come every few months now, I'm fascinated with the energy, with the hunger of the younger generation, of the next generation investors who are hungry to learn, who are hungry to perform and do well. And that's what brings me back to India again and again. So the fact that I'm standing here and talking to you about my story is really a very humbling experience. So I'm going to talk about public markets, talk a lot about the fixed income markets, and then throw something about the alternative assets. And I'm going to focus more on the real estate. So what drives the asset allocation is, who are my clients? Whose money do I really manage at the end of the day? So across the $180 billion pool, I have a variety of stakeholders in the UC system. Like I said, 300,000 students and 300,000 employees. My stakeholder constituents is widespread, and I need to make sure that I understand their risk profile and I understand the return expectation. Because the return expectation for something called working capital which is basically cash, which is basically liquidity, that is needed to run the University of California is very different from the retirement assets, which is basically people are expecting to get money back and more when they retire. And in the middle, you have the endowment, which is really needed to fund research projects at the University of California. So without money, there's no research. Professors have to build labs. Professors need the money for equipment. And it is expensive. And some of the research they do, it needs a lot of capital. And that capital is supplied by the endowment pool. So now, keep in mind, right? I just described 3 different kind of stakeholders. And I have to keep an eye on the portfolio while I'm managing my stakeholder expectation and making sure that that the markets are doing what it is doing and we are able to generate returns in order to pay the bills for these 3 stakeholders. Where are we invested? I'm not shy to tell you that I'm a US-centric investor. It's the best market, it's the deep market, the rule of law, and the US market has been on fire for the last 10 years. And I am so happy to tell you that we have participated in this massive US market rally. Whether it was coming out of the financial crisis or what is going on right now, the artificial intelligence boom. We have partaken and we have benefited from our investments in different markets. So we are primarily a US investor. I'm biased. I'm in California. The best research happens in technology or elsewhere is in my backyard. I don't even have to come here. I don't even have to travel anywhere. I just need to understand what is going on, spend a lot of time with people in California, and I'm well educated, and I know. The other place where there's a lot of things happening is in the UC system. Artificial intelligence came out of UC Berkeley. Professor Michael Johnson, you can go back and look. He's been talking about it for a long time. So we have the ecosystem of very smart people, Nobel Prize winners, who I can tap into as part of the UC ecosystem. I can go tell them, look, sit down with me and explain what is going on in AI, what is going on in CRISPR, what are some of the revolutionary things you're seeing in technology. I can have a conversation, and they're part of the UC, they're part of the UC family. So they will sit down and they have no qualms about discussing, because there's no proprietary information or something that I'm going to steal. I'm just learning. I have the advantage. I have some investments in Europe. I think Europe is a basket case. Not a big fan of what is going on in Europe. The other market outside of the United States that I'm super excited, not today, but for the last 10 years, is India. India has been put on the map now. It is a global player, but I still have a very small allocation, 2%. 2% of 180 billion is 3.6 billion. I went from 0 to 3.6 in 6 years. And I'm glad I did that. It takes time. It takes time. I have to travel. I have to come here. Even today, most institutional investors in the US who are more US-centric than me believe that India is full of snake charmers, that it is a very difficult market to understand. And then you have, blow-ups like the Adani case and the Hindenburg, and they're saying, you know what, we don't want to mess with it. So you have all those road bumps that you need to address. So that's part of education. Unless you come out here, unless I sit down with you, unless I feel your energy, unless I learn from you, sit down with you, spend time with you, understand what is going on, meet, big, well-known leaders in the investment community, in the corporate community, it is very difficult for anybody to make investment anywhere. And we have committed the time, we have committed the resources to come here, sit down. We have made, from 2014 till probably about 2016 or 2018, when we first started investing, we made 60 trips with senior leaders. You have to, unless you come out here and talk to people, it's going to be very difficult. And I'm confident that global investors are going to wake up. They have spent they have eggs on their faces with China. They have spent a lot of time on China and with abysmal returns. But we have not fallen into that trap. We did China, but we were more excited about India. And the advantage was, I was from here, probably the cultural understanding of how the system works. I don't understand everything, but to start somewhere, that trajectory really helped. And rest of Asia, we have 6, it is not as deep, and rest of the world is 3. So if you break down my investment portfolio into continents, North America or United States is number 1, some in the European continent, some in Asia, and we have nothing in Africa. And we don't intend because intend in looking at Africa because there are other opportunities worldwide. I spoke to you about this. Take a look at the products. So the retirement assets is about 133 billion today, 29 billion in the endowment, and 14 billion in working capital. And I have case studies in each of these products that I'm going to discuss. So I told you about the market growth of assets. Not a lot happened between 1994 and 2014. So between 1994 and 2014, we added 36 billion in the first decade, 94 to 04, and then we had added another 36 billion till 2014. But after 2014, we added 82 billion with the market taking off. But this AUM growth did not happen automatically. We did some tweaks to asset allocation. We did some tweaks to your strategy, and that is active management. We changed how we look at active versus passive. It was becoming very difficult for active managers to beat the index. So we changed our strategy. We threw in the towel on active management in developed markets back almost like 10 years ago. And we moved into passive. And we don't have any sophisticated modeling or, I don't have financial engineers working for me or, with PhDs and all that. No, you don't need all that sophisticated asset allocation modeling, nothing. You just need to look at your own portfolio and say, okay, what makes sense? You should have a heart-to-heart with your own portfolio, with your own investments. Is it working? Is it time to cut your losses? It's time to go somewhere else. That's part of the education. You have to build knowledge. Constantly. There is never a dull day in the market. You have to be in the business of constantly building knowledge. Even today, after 35 years in this business, I'm learning. It's amazing. It's fascinating. That's what excites me when I wake up and say, what am I going to learn new today? And trust me, you don't know anything. You meet some amazing people, you read some amazing stories, and you learn a lot. So I've been talking a lot now for 25 minutes. All this talk is good, but what is my track record? How has my portfolio done? And this chart kind of summarizes returns for 30 years. So start from the rightmost side. If you notice, 30 years ago, I had only stocks, I had only bonds, and I had cash. Okay? I had only the pension fund and the endowment. 30 years ago, I was not even invested in alternative assets. I didn't need to be. I just had stocks, bonds, and cash. But one thing we did was we always kept an eye on innovation. And the United States is at the forefront of any kind of innovation. And we never had our blinders on to learning about what was going on in the US system. So over 30 years, the pension, as of today, actually that number is even higher. We announced our results for the last fiscal year, which is going to be probably not the top decile, but the top percentile. We had some outstanding results for fiscal year ending June 30, 2024. Our pension did 12.2%, our endowment did 12.8%, our working capital pool did about 10%. So the 30-year returns on the pension is 9.3%. The 30-year returns on the endowment is 8.6%. And the way I manage my pension and the endowment portfolio is we understand assets. What are my liabilities? You have to focus on what your liabilities are. Because at the end of the day, you're managing money. You're an asset owner for somebody, and at some point they will say, okay, I need my money back. So on the pension side, the liabilities are pension payments. I need to make sure that when an employee at the UC system retires, they're comfortable and they have enough money. And that's what the pension portfolio does. And that is driven by an actuarial formula. So my hurdle rate is the actuarial rate of return, which is about 7%. So over 30 years, I have actually comfortably beaten the actuarial rate of return. Not too many pension funds can claim that in the United States. The endowment, our payout in the endowment to fund research, to keep the university running, is about 7% also. Now, the university is going to be here many years after I have left. The University of California, Berkeley was instituted in 1868. It's a 156-year-old system. It is going to be here for another hundreds of years. So I just want to make sure that the university is on a sound financial footing, because it's very important. If the university is bankrupt, what do? And you cannot afford to bankrupt a prestigious institution like the UC. So there's a lot of responsibility to make sure that you are being responsible and you're meeting your stakeholders' needs, but in the meantime, you're also making your assets grow. You cannot start depleting your assets to pay your bills. You need to pay your bills from asset growth, not from the principal. Okay? So long-term performance, spectacular. And I've been there, as I said, close to 26 plus years. And I take great pride in the fact that I have contributed to long-term performance in fixed income, in equity, in private assets, which I'm going to talk to you about. Okay? All right. So let's spend some time talking about asset allocation. So public equities, fixed income, private assets. Okay? So take a look at this pie chart and pay attention from right to left. How did the asset allocation change from 2014 to 2024? Very simple, right? We increased our allocation to public equities from 34% in 2014 to 59%. we slowly moved in that direction. And that enabled us to monetize returns in the stock market. Where did that money come from? What happened in 2014? Global financial crisis. We were just coming out of the global financial crisis. Fixed income was not an asset class. Fixed income was used for liquidity to pay your bills. Fixed income was not making me 7%. So we said, wait a minute, when an asset class is going to give me 0 for I don't know how long, I need to seriously think about where I am going to strategize and hope and pray that what the fixed income sector gave up is going to be made by some other sector. Liquidity drove returns. There was so much liquidity and fixed income returns were 0. We moved from 49%, today it is 20%. But today, I can stand here and tell you that fixed income in the US is back. For almost starting 2009 to till the Fed started raising rates, interest rates were 0. Interest rates were actually negative. $19 trillion worth of sovereign bonds, not in the United States, but globally, were negative yielding. So if you're an investor in fixed income globally, that means you are paying to invest. I mean, wait a minute. I did not get that message when I did my CFA, saying I need to pay to invest. So we reduced our allocation to fixed income, increased our allocation to equities, and we hoped and prayed. That's all we did. And we hope that be lucky rather than smart, and hope that the equity market would do well over the next 10 years, and we were not disappointed. So better lucky than smart with the equity markets. We also increased our allocation to private equity a little bit. We went from 4 to 8. We did a lot of private equity, globally, more in the United States, and significantly also in India. In private equity in India, we are a big believer in buyout strategies, because we feel that for our size and scale, no other strategy is going to move your needle in your portfolio in terms of returns apart from buyout. So we bet big on buyout, and the buyout strategy has done extremely well for us. In India, it did well in the United States, and that is in big trouble right now, and I'm going to talk about it. I still like the private equity market buyout in India, because the market's still young and the market's still growing, and leverage is not an issue, and I'm going to spend some time talking to you about the impact of leverage on alternative assets, especially in private equity and real estate. General endowment pool, it is very critical to support the programs and initiatives in the UC system. And that cash, like I told you, is going to come from my endowment pool, because you need to keep the university running. You let the professors do their research. You let the professors build their labs. You let the professors hire, win Nobel Prize and that's what attracts faculty to come work at the UC, because of research. There are many people who have left Harvard, MIT, and they moved to Berkeley because they just want to do research. And it is the best place on earth to do research, because you can get funding, and you have the culture, you have the research culture in the UC system, okay? So we created, the general endowment pool, and I'm going to talk to you a little bit about the blue and gold pool we created over the last 5 years, also part of the endowment. And we took a lot of the working capital, we spoke to the campuses, and we said, look, we need the money to fund future research, future growth, like 20, 30 years from now, and we created the blue and gold pool. What has been my performance in the endowment, but more importantly, who do I serve? Who are my clients? Who do I report to? I report to 300,000 students. I talk to students all day long. They have, my best learnings at the UC has been from the students, has been from the younger generation. They come and talk to us, and they tell us what's going on in the system, what are we doing right, and what is the right way to do it. Fossil fuels, for example. The students put their foot down. They said, we need, let's talk about sustainability. Let's talk about green energy. So they educated us. So today, when we invest, it is tobacco-free, fossil-free, thanks to the students. I report to the 300,000 students. My door is open to talk to anybody if they have an idea and they want to talk to me about what's on their mind. And we definitely need to do that. My payout from the endowment today is $675 million that is paid out for research, to run the university, to as scholarships for students, to get talent from, to get faculty talent from outside. So I use that money to do that, and the returns have been pretty good. I would say the returns have been spectacular over the last 30 years, even on the 10-year basis. Retirement. 60% of the US population cannot retire because they don't have money to retire. Retirement planning, financial planning is very important. So we have been educating our employees. We tell them, you have a defined benefit program where you'll get a pension after you work for a certain number of years. You will get a pension, but apart from the pension, we also encourage our employees to set aside money on a pre-tax basis. So you have the defined benefit pool, which is the pension. The defined contribution pool is also available for UC employees to save for their retirement. So today, the pension portfolio is $100 billion, but the defined contribution pool is approaching $40 billion. So every year, UC employees set aside $1.2 billion, just like you have your SIPs here, which is more like people doing voluntarily. People want to save pre-tax, and that pool of assets is $40 billion. And let me tell you, the defined contribution portfolio at the UC is the second largest public pool of funds after the US government. So we are the second largest pool for the in a public setting. So we manage money for our pensioners, and they set aside money, and they have a choice of, they have options to invest, and that is on them, and we educate them. We tell them, if you don't want to speculate, we have target date funds available for you. And target date funds dynamically shift asset allocation. A young employee joining the UC has more in equities, very little in fixed income. And as the employee goes through the life cycle working at the UC, we change the allocation dynamically and tilt it towards more fixed income and less equity, which is basically we are lowering risk. So those are the target date funds. But if employees feel that, hey, I know more than the target date funds, and if they want to manage money on their own, they want to be their own PM, so we give them an option of 13 core UC options. It is run by UC investments for UC employees, like a stock portfolio, a bond portfolio, a TIPS portfolio, an emerging market portfolio. So we give them the option. And if you're not as satisfied with either the target date or selecting funds, you can actually go to the Fidelity brokerage window, and you can swing to the fences. You can buy the hottest stock or hottest fund, and that's 2.8 billion. But fortunately, there's not too many people doing that. 90% of the people are either in target date funds or they are in the core options that is offered by UC. And the advantage of the UC, the UC lineup is it costs them only like 3 basis points. It's pretty much free. There's no management fees, nothing. We just charge them a flat 3 basis points. Okay, so I spoke to you about the pension. There are almost 300,000 pensioners in the UC system. There are about 80,000 retirees. And some people live till 100, and they've been retired for like 40 years. Get a pension check. So I need to manage that because longevity with medical technology and how people live, the lifestyle is changing dramatically. The health consciousness and all that. So the lifespan has increased. So which means that they are going to live longer after they retire, which means I need to change my asset allocation. I need to manage that. And I do that in asset allocation. And that data, which is so valuable, is given to me by my actuaries. I work very closely with the actuaries who kind of educate me on the demographic base of the employees in the UC system. We've been investing in the endowment for 92 years. So we plan for what is called as centennial performance. We want to invest for the next 100 years because the UC is going to be around. We have to make sure that there's enough money for employees, for students, for faculty. We are in this long haul. I cannot worry about market going up and down every day. Even though I watch it, I'm a long-term investor. I have to have a long-term focus. Asset allocation is secular. Asset allocation is not static. You don't want to do dynamic asset allocation changes. You should have a secular view in asset allocation. Spot secular trends, interest rates, demographics, inflation, what's going on in different countries. So you have to identify secular trends, and as you spend more time on the job and learn and talk to more people, you actually get to, it becomes very interesting. And trust me, you would change your asset allocation, you change your thinking constantly. The way I manage money now is very different from when I first started at the UC about 26 years ago. We have been managing the pension for 64 years and so on. So the baby of all this is the blue and gold pool, which we just started about 5 years ago. So these are our different products, okay? We like to keep things simple. I do not invest in stuff I don't understand. Cryptocurrency, I have no idea. Life is too short. Okay, I'm sure it is going to move markets and all that, but I still want to understand the regulatory part. How are the regulators protecting me if there is something that happens in the market? I think the US regulators are still struggling. It is getting much better, the SEC and the other regulators, even in India. Hopefully, once I have the playbook, it's okay not to invest now when it's going like crazy. It's okay. But you want to understand your strategy, understand your investment style, understand the product, keep it simple, and invest only if you understand. Only if you understand returns and if you understand cash flows. So one of the most simple things we have done is we have moved from active management in the US to passive. This statistic is mind-boggling. When I was managing 95 billion back in 2014, my passive was only 30. Active was 65. But over the period of time, I learned that active managers, not only do they underperform, there is a lack of alignment. They get paid when markets are up, and I get to take the brunt when the markets go down. They want to give me my money back when markets go down. And they want to get paid every year when the markets go up. So we got the joke. We said, okay, thank you very much. You've done a great job. You have underperformed massively, this basic benchmarks. So we fired. In 2014, we had 280 relationships. Today, my asset size is almost double, but I only have 30 partners. I don't need more than that. Less is more. Concentration. We moved a bulk of our active to passive, and let me tell you, the S&P 500 has beaten 99% of the managers. And you know how much I pay for the S&P 500? 1 basis point. My passive investments cost me 1 basis point for full liquidity. I can liquidate tomorrow. With active managers, there are gates, there are lockups. Oh, sorry, Satish, you missed this quarter's redemption. You have to wait till the next quarter. Okay, it's my money, man. I want it, and I want it right now. Can't have it. Okay. We learned our lesson. So today we have very little. We have only about 10% in passive, in active. But let me tell you where I believe active management makes a lot of sense. In India. In India, active management is going to rule. Because the way the index is constructed, there is a lot of misalignment with strategies. If I were to invest in the MSCI India, my students are going to be at my doorstep next day. There's Coal India. There are oil companies. I cannot invest. But I can hire a manager here and say, these are my rules. This is my playbook. Go for it. In spite of that, in spite of a really constrained rule book, there is significant room for active managers, and my active managers have done lights out. And there is a significant runway in India for active management because there's still a lot of low-hanging fruit. It's a growing economy. Economy growing at 6 to 8%. So there are going to be many companies. And let me tell you something, and I'm going to talk about this when I talk about India. In 2014, when I started following India, and by the way, till 2014, I would not invest a dime in India. And I was already in the US for 30 years. I've been there 40 years, like I told you. I would not invest a dime in India because I did not understand the governance. I did not understand the reporting. There was lack of trust. Things changed in 2014. And I'm so glad we opened our eyes and said, oh, you know what, let's go and learn. And so glad we did that because today I'm so confident that India is going to be an outperformance. And I'm going to show you some equity charts that's really mind-boggling about India performance that very few people in the US even keep an eye on. Since 2014, after firing active managers, I have saved $3 billion in fees. Think about it. That's stakeholder money. When I have no business, giving away stakeholder money and then paying all kinds of fees to misaligned managers. $3 billion in fees. Either performance fees or management fees or you name it. I mean, there's a whole, it's bigger than the portfolio. Bigger than the line items is the number of the items they charge me for fees. All right, so that was the story of you see in the background. Now I'm going to talk to you about case studies and what I have done to identify trends. How much time did I take? I got time? Okay. So identifying and monetizing on secular trends, what have we done? And what was our thinking? What was our strategy? All right? So I'm going to talk to you about 5 case studies. There are quite a few, but 5 of them have moved the needle, and they have done wonders for the UC system in terms of returns. Okay? So let's start with the first one, long duration fixed income. From 1980 to 2020, secular trend of declining interest rates. I came to the UC in 98. And day one, I said, okay, I want to learn about the portfolio. And they showed me what the portfolio was, what it looked like. In 1998, believe it or not, the fixed income allocation was 35%. The portfolio owned every long duration bond there was on this planet. So the person who hired me back then, I said, please, I'm new, I'm learning, I want to sit down with you and I want to talk to you. Patty Small, the treasurer who hired me in 98, sat down with me and she explained. And she was there from 1976. So people who work in the UC, they work for a long time, man. So she explained. She said, when Paul Volcker became the chair of the Federal Reserve, she met with Paul Volcker, and she was so confident in the Fed, in its ability to fight inflation. She bought every long duration bond there was. What a bet. What happened to interest rates? She left in 2000, but that portfolio from 1980, it roared all the way till recently, till almost 40 years, till 2020, when we had long duration bonds. And things changed in 2020, and I'm going to tell you what happened, and that was incorporated by the current team. So she said 3 things. She said, I have tremendous faith in Paul Volcker and the Fed to fight inflation. Inflation is coming down, number 1. Number 2, she was energetic, excited about the US. The stock portfolio was concentrated in large cap equities. And there were only like 10 names. And then finally, she had this foresight about technological innovation. The UC system was the first university system to invest in venture capital. The Harvards and the MITs and the Yale only came later on. We've been doing this since 1976. Why? Because of companies in our backyard, Intel, Motorola, Cisco. So she allocated a small amount to venture capital. That was very simple, something easy to understand. The Fed's ability to fight inflation, buy long duration bonds, interest rates will come down. Load up on concentration in large cap US equities because the market's going to do well with inflation coming down, and finally with venture capital. This is in the pension portfolio. What are my liabilities? I need to make liability checks to people who retire. For 20 years, the fixed income portfolio had equity-like returns, even better than US equities. So in 1989, take a look at this chart. Take a look at this chart. In 88, 89, we were 150% funded. Our asset liability ratio was 1.5. We had more assets than liabilities. What did the university do? they told all the employees, you can stop contributing into your own pension plan because we have enough money to pay your retirement. From 1989 to 2014, for a period of 25 years, neither the employee nor the employer contributed into the pension plan. I mean, pension is not automatic, folks. You cannot work and say you retire and say, okay, I want my pension. You need to contribute to your own pension. And you hope you will get back more, but you need to make the contribution. In 2014, we reinstated contribution. But for 25 years, UC employees did not have to contribute because of what the treasurer or the CIO did back then. Equities, long duration assets. And after the great financial crisis, and as the UC system was expanding, we reinstated our contribution. Okay, so today, in spite of all that, and in spite of growth, on an actuarial basis, and many CFA charter holders here, you understand plan value of obligations, liabilities. We are probably about 85% funded, and I can tell you with confidence that in the state of California, we are the best funded defined benefit plan across the other defined benefit pools like the CalPERS or the CalSTRS, whose asset liability funding ratio is only about, I don't think it's more than 60 or 65%. So that was the case study back. That was the first one, long duration bonds. Active management of working capital. When I started in 1998 and I started managing cash, so I was responsible for the cash for the UC system, and I was tracking inflows and outflows, right? Liquidity, I need to pay bills. So the amount of bills I was paying was actually significantly lower than the amount of money coming in. So what was happening to my cash base? My cash base was growing, the campus money, the campus cash was growing, and very few people were actually monitoring that. So one day we sat down with the head of the UC system, the president, and said, we want to talk to you about a strategy that we have in mind, observing what the cash flow is across the UC system. So we said, look, it's working capital. You need cash to pay your bills. We get that. But there is significantly more money outside, more than what you actually need for 90-day cash on hand. You can make cash on hand 90 days where you don't have to get any money, but you have enough to pay your bills. So we said the cash on hand is crazy. So we decided, we proposed a plan. We said, look, cash is building and this is not going to stop anytime soon. So we recommend that we take some of the cash out and take a little bit more risk, basically buying equities. Because we felt that over a long period of time, that equities would give a higher return than cash. Very simple. We did the math, not rocket science. I don't need a master's in financial engineering. We said we track the returns, what the equities have done, what fixed income has done, what cash is doing. And we said we will be able to give you 2% more over a long period of time. So we took about, I would say about $5-6 billion out of the pool, and we told the chancellors that we would like to create a new product with a new asset allocation, with a new investment policy statement. So we created a total return investment pool. Think about me like a financial planner for the UC system. I'm helping my chancellors with financial planning, saying, let me help you manage your money better. It's your money, your campus cash sitting here. So we created the TRIP. Better lucky than smart. Guess what happened? We started doing this and at the UC system, things move slowly. It takes like 1, 2, 3 years before we put action items. Financial crisis happened. The great financial crisis happened. We said, fantastic. I can buy stocks now, which was up almost 30%, and it's down 40% now. So from up 30% during the financial crisis, it went down 40%. Best time to invest. But of course, markets were choppy initially, people were nervous, but we moved a good chunk of cash into the total return pool, and we created TRIP. And then what happened to equities? Equities just took off, and these are all, and this is the MSCI All Country World Index. It does not even have the S&P 500. It has the global stock index. And today, I have $10 billion in TRIP, which is allocated very simple, 50% stocks and 50% bonds. When I invested, bonds was 0. And I said, if equities can give me like 6%, then I can generate 3% for my entire portfolio. And if cash is 0, I'm earning 300 basis points over my cash. But guess what? Actually, I've done even better. Thanks to the equity markets. I have outperformed since the time, 15 years ago when we created the total return investment pool, I have handily beaten cash by more. And all that cash belongs to the campuses. Now they're looking at their balance sheet saying, when we set our budgets, we can use some of that as operating income to run the university because this is your cash, full liquidity. Okay, so that's case study 2. Case study 3, what makes UC UC? I talked to you about Nobel Prize winners in science or in economics. March 14, 2020, we got a memo saying everything shut down. Everybody just go home. Nobody come out. The pandemic hit. We have to run a university of 300,000 students, 300,000 employees. So a couple of us from the UC Investments got together with the president and all the chancellors saying, so the first question we asked is, how much cash do you need? Without firing anybody, how long do you want to run the university and pay your employees? They said probably 2 years, 24 months. My payroll every month is 1.2 billion. 1.2 billion times 24, close to 30 billion. So we raised liquidity in the markets, 30 billion. At the same time, we were invited to participate on calls with medical professionals, and these are leading edge medical professionals in the industry, from University of California, San Francisco, from Pfizer, from Moderna. The collaboration we saw just blew us away. We were stunned that so many smart-minded people coming together to work on a cure for the pandemic. After about 2 calls, internally, we said, wait a minute. If this kind of collaboration is happening at a global level, there's going to be a vaccine. These guys are smart. They will figure it out. They will figure out what the virus is. There will be a vaccine. And this is not the end of the world. So the 30 billion we had raised, we started putting money in equities. We moved all the 30 billion from cash into public equities. And guess what happened after that? There was a vaccine, there was a cure. People went back, albeit slowly, but people got the confidence that they were going to live. I mean, in many countries, people died. We are so blessed to be standing here today. You can't forget people who passed away, right? But the vaccine gave us the confidence, the discussions gave us the confidence, the collaboration that was happening at the global level was just mind-boggling. So that is what makes UC. UC is the power of collaboration and the power of the UC system to bring leading people in the world together. Okay, and case study 4, pandemic happened, interest rates went down to 0, went to negative. We changed our fixed income strategy. We said, the days of active fixed income management is over. Interest rates are 0. It is return of principal, not the return of principal. So we moved from long duration to the shortest duration possible. Not today, in 2020. And guess what happened after that? As the economy came back, the Fed raised rates, and today, that delta between long duration and short duration is 900 basis points on almost, $15 billion. So the value added in all these strategies, folks, that we have done is $6 billion in active management. So that was the case study 4, and case study 5, we are trying to manage inflation, and inflation management is going to be critical as you set aside your views on interest rates, because for 40 years, the alternative assets did not care about leverage. For 40 years, the alternative assets did not care about leverage because leverage was going down. They used leverage like candy. Private equity, real estate. So we got the joke, and what we did was we started selling real estate, which we had access to in our portfolio like there was no tomorrow. So we sold about $4 billion in real estate. Just before the Fed started raising rates, we stopped. And after that, the market ceased. The real estate market collapsed. We entered into a discussion with Blackstone, where they needed some. We said, we can partner with you, give you some capital. They guaranteed us 11.25% on $4.5 billion. And we took that money that we raised and we invested for a return of 11.25% for the next 5 years. So that's what we did on the alternative side, okay? So now, let me wrap up. Role of leverage in alternative assets, very critical. Leverage is very important for private equity functions. For 40 years they forgot, but now they have to come up with organic growth. They want to invest in companies, either buy out or take private strategies where there is organic growth. Okay? So some of the risks. Risk rules is one of our most important, we pay attention to risk rules. And we'll do when we talk about India in the Q&A, I'm going to show you some charts. India has outperformed every global market, including the US, in the last 1 year, and fantastic performance even in the last 10 years. And this is, by the way, US dollar returns. This is not INR. This is USD returns after taxes. And outside of the US, the India market has been the lone outperformer. Risk rules, we pay attention to a lot of risk. And what keeps me up at night? Inflation keeps me up at night, geopolitics, the US elections, artificial intelligence, and I'm really worried about the US deficit and the US interest expense and the power of the US as percentage of GDP is going down significantly, okay? So, and I'm going to wrap up by saying these are the 10 pillars, and I have referenced most of this in my talk. Less is more, risk rules, concentrate, creativity pays, that BRE transaction we did, and build knowledge. We built knowledge in India. We just didn't come in and write a check. We said we want to learn, we want to talk to people. So we spent a significant amount of time learning about India, and that was a build knowledge. So let me stop here, and sorry, did I go overboard? I'm okay? Okay. All right, so let's do, thank you.
I'm sure, Satish has explained a lot of things to us. At the same time, at least as part of the audience, I have so many questions for him. And I'm very happy to share that, even though we have very limited time for Q&A, you're going to join us for lunch, and I'm sure you'll be doing a lot of talking while we eat. But But you started off by saying SIES college, you know, it took me back to when I was in the same college.
You were, okay.
Yeah, and I have played cricket in that same behind the bus depot. I'm very sorry to inform you it's not there anymore.
Oh, the playground is not there anymore?
No.
Okay. They built apartments?
Yes.
Oh, okay.
Hey, what do you expect? This is Mumbai. But let me start off, I've got a lot of questions, I've distilled some of them. So let me start off by asking you a very simple question that's on everybody's mind is, you know, you look at India among many other markets, developed markets, emerging markets, all of that, and you have some background and understanding of the country and, you know, what's been going on. I presume you still have roots here, etc. So if we are, as an audience, to look at you as representing the US investor, which remains the biggest pool of assets to be investing anywhere, and at this time you yourself are 2%. Over the next 5-10 years, where do you see this whole economic shift?
Right.
With India being the flavor, everybody, at least in India, we believe we are it. You know, we are where everybody should be investing.
Right.
So how do you, as an institutional investor, you know, look at India, and what would you advise for asset allocators in those markets about India?
So advising US global investors about India.
Yeah, when they're looking at India.
How do you think? So I did talk about a little bit, you know, in my presentation. It's important to come here. It is important to take the trip, spend some time. I did not come in and, like I said, I did not start investing right away. We took the time, senior leaders on the UC team, to come, spend some time, and understand the landscape, understand who the players are, and understand who meets your you know, risk standards or your corporate governance standards. At the end of the day, it is investing in India is easy. You know, people can write a lot of checks, billions of dollars, but liquidity is important. I need my money when I want it, not that when, you know, managers can give me. So liquidity is still, you know, it's getting better, but it is still not a deep market, not a liquid market. But I'm okay with that. I'm patient. I'm going to be around for a long time, and I have a very small allocation. But global investors have a very different mindset about India, just sitting in California. And I'll tell you why. They have been spoiled by the returns in the US and outside the US a little bit. Sure. So they said, you know, why bother about a currency? By the way, when I invest in India, I underwrite the INR negative 3.5% every year. So I'm already down 3.5% because it's very simple. You go back and look at 40 years, the currency has actually depreciated on an annual basis at about 3.5%. It is not a linear depreciation. It is a step function, right? Nothing happens and then boom. Nothing happens and then boom, right? So you need to factor. So people are saying, you know, I don't know the currency, why factor? But I think the mindset is changing. More and more US investors are talking, and the other thing is, when everybody was focused on China, we actually came to India. And today, people who went to China, they have gotten hammered. They have lost a lot of money. So they have taken all that money out. They're still a little gun shy. And I think you are going to see more. But what gives me a great confidence, and I'm so thrilled to see what the Indian markets have done in the last few years, is net FIIs have actually been, you know, withdrawing money, but still the market is going up. You know, it's okay, because domestic investors, retail investors, domestic mutual funds, asset managers are putting money. The SIPs are coming in, they're putting money. That is not stopping any time soon. That train is running full steam, and I don't see that stopping. And I think FIIs can do whatever they like, but I think they are missing out. But having said that, things are changing, and people are willing to learn and willing to kind of, you know, meet. You know, there's been a lot of bad blood between India investing in India in the 90s from Unist investors, and I know, I don't want to name the university that is very close to where I am. They lost a lot of money by going into boutique shops and by going into where there was no alignment, where the promoters just decided to cash out and then close shop and whatever. So there's a lot of history of losing money. So and that mindset kind of takes a generation to kind of shift.
Yeah, we understand that. In the 90s is when the regulator was set up in the first place. So it's a long way to go. I think we should have more direct flights from India to the US. No?
There are a few.
Easier
actually.
for them. Yeah, we
Yeah.
should have many more. Easier for them to
Yeah.
come. Yeah. I think one of the areas that you spoke widely on was asset allocation.
Correct.
And I think most of us are wealth managers here in one way or the other. We keep thinking asset allocation. And we saw that whole shift that you did with your portfolio where equity and fixed income, there was a complete swap. You went from 30 something to 50 something and rates have moved. So you've been proven right. We find ourselves at a very interesting juncture today where rates have moved from one extreme of 0% to another extreme because people are not expecting cuts. So how are you thinking of again switching your portfolio allocation when you look at your asset broadly?
Correct.
Or and again 5-10 years.
So absolutely, I think fixed income as an asset class is back, but what we have done better than most is if you're a student of the yield curve, the front end yields in the US is still inverted. That inversion actually is turning around, but since the pandemic, when the Fed started raising rates, the yield curve got massively inverted. So the amount of return per unit of risk I can earn with an inverted yield curve versus investing in a long duration bond still favors me because of the inversion. I will change my mind of investing and increasing my allocation fixed income, and more importantly, increasing my duration only if I see the yield curve become normal. I like the front end of the yield curve, and I'm still very happy. And the Fed is going to be very gradual, by the way. And one thing I didn't talk about is inflation is here to stay. Deglobalization is happening. There's no more globalization. Supply chain problems still exist. And the US is still printing money. This year, there's going to be $12 trillion of sovereign bonds that are going to be issued, and 40% of that $5 trillion is in the US. So there's so much supply, and if there's no demand, what happens? Prices go down. More supply, economics 101. So we still feel that there's a lot of pressure on interest rates. We're not going to go back to zero. And this time around, I don't think the Fed is going to cut, even if they start cutting aggressively. We never believed in the Fed cut rhetoric. We continue to say that the US economy is strong and short duration is where to be. And I'm glad we did not listen to all the experts out there that were calling for 6 rate cuts in 2024. And we said there's going to be 0 rate cuts. So far, I've been right. Even if the Fed cuts, there's not going to be many Fed rate cuts, because at the end of the day, Fed rate cuts are a tool to prevent an economy from going into deep recession. I don't see that. I think the US economy is still okay, 2.8% GDP that came out last week, and global GDP is okay, but the Fed cuts are not going to be, it's going to be shallow. So I still like the front end of the yield curve, and I still like my strategy. I want to keep low fixed income, but earn a higher yield.
Interesting. So we maintain that.
Maintain.
Right. I think there's one thing, and congratulations on $180 billion. We saw the whole growth in AUM, and I think there's something that all of us can learn from your experience over the last 20 plus years. Is that you've seen a massive growth in AUM. In terms of quantum, it's really a very different number today that you're managing than you were even 10 years back or 15, 20 years back. And I think most of us here in the room can identify with that because, believe it or not, India has done as well as the US in our context, right? And I think there's something that's a question on our mind is if we were managing $1 10 years back, it's really significantly grown. So what are some learnings that you can share with us in terms of when the size of or the scale changes, when you've seen that scale change, what are those 2-3 things that come to your mind that you think can help all of us, manage a higher level of operations?
That's a great question, because to me, diversification and investing in everything under the sun is important. But at some point, we're all investment professionals. We are paid to take risk. You don't need to, you do not need to expand your risk basket. You can concentrate your risk, have a strong conviction, and you don't need to own like hundreds of stocks. You work actively with a few companies, or a good set of diversified companies, and as your asset base is growing, the easy way out is to just buy everything under the sun and look like an index. But why do I need you, right? Why does the client need an active manager? You are paid to outperform the index. I might as well be in the index if you are going to look like an index. So I think you have to be very careful about just diversification for the sake of diversification. You still, and this is the challenge India is going to have, is because right now you don't have the problem. Yeah. Because there's a lot of low-hanging fruit. I have seen some really interesting portfolios that some of the asset managers have shown to me, and I'm sure even probably you have not heard of those companies, and those companies have taken off, and there's so many companies. And I think at some point you're going to have critical mass that's going to do well. Yeah. And then you can just manage around that. But what is more important is, as investment professionals, you have to provide the liquidity when your client asks. You cannot give excuses saying, oh, I cannot sell this stock because, stock's not trading or liquidity is thin. So you need to anticipate liquidity moves within your own portfolio, because cash is king. People want to monetize some of the returns. And so as you're constructing your diversified portfolio, it is important to do concentration, but at the same time, you have to provide liquidity to your clients.
You do. So I'm also mindful of the time. So yeah. Last couple of questions. Again, there's a whole list of questions. I'm sure people will be gathering you outside. But one of the things that you mentioned in your address was about India's reputation in global markets, especially, you have all these incidents that blow out of proportion. You mentioned the Hindenburg report on Adani, and, similarly, many other things. From your standpoint, from the way you look at India as a market, what are those few things that you think India should be doing as a nation to change that impression, to really share with the world how, digital adoption, for example, or how seamless the regulators, steps have been in terms of aligning to global best practices? What are those 2-3 things that I'm sure they are basic things which, in a way, we will be doing, we are already doing. But when you look at India and you say, okay, you know what, there are these problems, but there are problems in every market. US has their own problems, which, we can list them down. But how do we change that impression, or how do we walk that path that allows investors who really don't understand India yet to walk that path and take those trips and, put in the effort?
Right. So unfortunately, the Western media loves to talk negative things about India. Like talk negative things about Modi and how right-wing he is and all that. And then when something like the Hindenburg report comes up, it blows up, and they love to slice and dice and saying, and those are some of the articles, unfortunately, is read by people in the US. Okay? So there is a very bias even in the Western press about India. I mean, every country has a problem, and you can talk about the political landscape, and US definitely has its own share. Absolutely, I totally agree. But what has helped UC is to come out here, is to learn, is to sit down, educate, talk to the Uday Kotaks of the world, and talk to the Ratan Tatas of the world, and then learn from them, and and then understand, talk to budding entrepreneurs.
Yes.
Like 361, hungry, eager to grow. What are some of the challenges? I think I would say those are some of the takeaways is unless you come out here and understand what the problems and what the solutions are, and spend a lot of time with the regulators and, RBI. I've spent a lot of time with the RBI, with SEBI.
That's so important. Yeah.
Very important. And also with the government.
Yeah.
I mean, I have made a number of trips, met, Piyush Goyal and Nirmala Sitharaman and, PMO. So it's important to come out there, because I think once you start having that, India is on a trajectory, I think, to exceed even probably, the 6.5, 7.5 growth rate, if they get capital and, you get all these infrastructure projects going. And one thing I am really encouraged with the new budget is the importance on education.
Yes.
Whereas US actually is not spending a lot of time on improving skills, but I see India changing. So all those actually, unless you come out here and learn and understand some of the dynamics, problems will always happen. There will always be
it's part of life.
There will always be a black swan in your portfolio.
Yeah. No, that's very helpful. I think one last question for all wealth managers here before I let you go is, since most of us are wealth managers, as I said, what are those 2, 3, things, learnings, lessons that you've learned over the years that you want to share with us, which will help us become better in what we do?
Correct. So clearly, to me, the underpinning of what I do is asset allocation and investment policy statements. You have to be extremely transparent in what you do, and you should be able to explain it to somebody who does not understand investments, saying, this is what I'm trying to do, what do you think? If you can actually get the buy-in of that person and then make them understand, and that's what we do. We talk to our students, we talk to our faculty and say, okay, this is what we are thinking, and they are not investment professionals, okay? So this is what we are thinking, what do you think we should do? Do you understand what we are doing? And then talk to the layman, lay people who are not very sophisticated, but the simplicity in what you do is perhaps is a gift. And that I think if you can cultivate that and develop that and articulate that, I think the sky is your horizon.
So keep things simple.
Keep things very simple. Be transparent. Be very transparent in what you do. Be honest in what companies you invest in, and have a constant communication discussion and understand risk. To me, before I'm a portfolio manager, I'm a risk manager.
Yes, you said that.
What keeps us up at night? Very important. Okay, I cannot drive a car looking at the rear view mirror because I have a 9.3% return in my pension, in my endowment over the last 30 years. What's on the horizon? How do I drive the car looking forward? And what are some of the risks on the horizon rather than looking
backwards? Excellent. Ladies and gentlemen, a big hand of applause.
Oh, thank you. Thank you.
Excellent session, sir. You could distill 2.5, 3 decades of experience into an hour. Great learning. Round of applause for Satish sir again. I would love to call my dear friend Litesh Gada, director of the society, to give a token of appreciation.